Layoffs are rising, consumer confidence is falling, and yet the stock market marches higher. How long can this divergence last? What will give first, Wall Street or Main Street? What should you be doing with your money right now? As the US government shutdown approaches the 1-month mark, there's little evidence that the two sides are making progress towards a resolution. With the flow of official data cut off, economists, myself included, have been groping in the dark for clues about the state of the US economy. I will be the first to admit that it hasn't been easy. But in the past week, I've had something of a eureka moment. Something clicked. Things are starting to make more sense to me. Let me see if I can explain what I mean. The September consumer price inflation came in weaker than expected. Core goods inflation rose by just 0.2%, down from 0.3% in August. Still no signs of pass-through of tariffs, even though tariff revenue is now running at $30 billion a month for the past 3 months. I'm not saying that September is not a tricky month. With a lot of new product releases in October ahead of holiday shopping, the discounting of older models in September could have a depressing effect on inflation. But September is also a time for last-minute back-to-school shopping. August and September offer retailers an opportunity to reset prices for things like apparel and school supplies. Apparel inflation rose by 0.7% in September, after a 0.5% increase in August. But in the greater scheme of things, these are still small increases compared to the tariff rate at the highest level since the Great Depression. The implication is that consumers are cautious and that firms have little pricing power. This suggests firms have little choice but to absorb the tariffs in their profit margins. But if this is the case, how can we explain another strong corporate earnings season so far? Halfway through the Q3 earnings season, 81% of S&P 500 companies have beaten the consensus estimates. But if we just focus on the operating margins of those companies that have reported, the picture does not look so good. Operating margins are calculated as operating earnings, excluding interest and tax, divided by revenue. Trump's tariffs have brought about a massive shift in the relative prices between US-produced goods and in imported goods. This should increase the market share and pricing power of US manufacturers. All else being equal, their operating margins ought to improve. But this is not what's happening. Let's look at the 6 largest US industrial companies: GM, Ford, Tesla, Honeywell, Boeing, and Caterpillar. With the exception of Ford and Boeing, all the others saw a decline in their operating margins compared to a year ago. In the case of GM, its operating margin fell to just 2.2% in Q3, compared to 7.5% in Q3 2024. This is despite the fact that GM is seeing a surge in demand for its high-margin luxury trucks like the Sierra, the Nelly Ultimate that starts at $85,000. This pressure on operating margins, which I expect to see also among retailers when they release their earnings next month, is also consistent with the lack of pricing power. It is impossible to prove, but I'm becoming more and more convinced that the strong retail sales we saw during the summer was driven in large part by preemptive buying ahead of expected price increases. In other words, we should be careful to assume that US consumers will continue to carry the economy on their shoulders. So what do you do if you are the CEO of a company whose operating margin is under pressure because you can't pass on the tariffs onto your customers? The answer is simple. You cut costs, you reduce headcounts. This week, Amazon announced that it will lay off 14,000 workers. UPS said that it's cut 34,000 operating positions over the past 9 months. Target said last week that it would let go of 1,000 workers. Applied Material is laying off 1,400 workers. Accenture early in the month said that it will lay off at least 11,000 workers. According to the Challenger report, US companies have laid off 940,000 workers in the first 9 months of this year. This makes it the highest since the 2020 recession. Indeed, it is close to or even at recessionary levels. What's more, the layoffs are spreading across many industries. I have no doubt increasing job insecurity is the main driver behind the slump in consumer sentiment. Consumer confidence fell again in October, for the third consecutive month, to the lowest level since April. This is despite the fact that the stock market is up 40% since April, gasoline prices down, and 30-year mortgage rate is down. It is very clear that Americans are worried about their jobs and see more job cuts coming. According to the Conference Board survey, only 15.8% of Americans are now expecting more jobs to be available 6 months from now, lower than the 16.6% seen in September. The holiday shopping season had just started. I think it will be weaker than usual, possibly much weaker. Sellers seem to have become resigned to this prospect. Seasonal hiring is softer than usual. UPS announced a holiday hiring spree in late September 2024 with a goal of 125,000 hires. There's been no such announcement so far this year. Last year, Target made 100,000 seasonal hires during the holiday shopping season. It has said nothing so far this year about seasonal hiring. Consumer spending is 70% of US GDP, and this year is even higher in Q4 because of holiday shopping. I think we're looking at a very weak holiday shopping season, and that Q4 GDP growth will slow sharply. Wall Street consensus is that GDP growth will slow down to just 1.1% in Q4, down from 2.7%. In my view, the risk is to the downside. Does this mean that we are heading to a recession in 2026? Since the start of Trump's second term, we've seen a surge in layoffs and a sharp decline in consumer confidence. The only thing that has been going Trump's way is the stock market, of course. Indeed, the US economy might have already gone into a recession if it weren't for the surging stock market. The surging stock market is creating wealth, a lot of wealth, for those who own stocks. This is why the sale of luxury trucks are booming. This is why luxury travel is booming. Delta Airlines reported this week that premium cabin revenue increased by 9% year over year, while main cabin revenue dipped by 4%. This is what really is going on. The AI bubble aside, the stock market is going up because companies have been able to protect their bottom line by laying off workers. But their bottom line has also been helped by the surging stock market that is fueling the spending of the well-to-do American households. In other words, the stock market rally has become self-fulfilling. The more it goes up, the better corporate earnings look, which pushes up stocks even more. This is what George Soros calls reflexivity. And reflexivity leads to bubbles. Scott Bessent, Trump's Treasury Secretary, used to work for Soros. I'm sure he gets the joke. This is likely why Bessent and Trump have become the biggest cheerleaders of the stock market. They're market-savvy people who realize what it means when a bubble bursts. This is why they're pressuring the Fed to cut interest rates. This is why the pushback by Jerome Powell this week on a December cut was so interesting. What it says to me is that the Fed does not want to blow more air into the stock market. The Fed is never going to say that the AI rally is a bubble, but it does not mean that it wants to be its accomplice. What all this says to me is that the US economy is in trouble, especially if I'm right that the AI bubble is not sustainable. As I've argued in many previous videos, the AI bubble faces two major risks. One, the AI revenue growth ramps up more slowly than expected. Two, that China closes the technology lead of the US more quickly than expected. I think both risks are growing and underpriced. I remain short NASDAQ 100 and long Nifty 50. The NASDAQ leg has been painful, but I'm staying with it. I'm also short US consumer discretionary versus staples. I'm also long 5-year Treasury notes. If I'm right about the bubble bursting, the Fed will have no choice but to come to its rescue in good time. That much I have no doubt. Thank you for listening.